9 types of investment risk and why you need some of them. Most investors think risk means one thing, losing money in the stock market. But that's only one type of risk. In reality, there are multiple risks that can impact your financial future. Some are obvious, some are hidden, some are risks you should try to avoid, and others are risks that you really need to embrace if you want long-term growth. The goal isn't to eliminate risk, the goal is to understand which risk you're taking and why. My name is Buddy McNeese. I've been advising wealthy families on St. Simon's Island for over 31 years. Let's look at some of the risks that we see. Number 1, market risks. This is a risk that stocks, bonds, or other investments decline in value. For example, the S&P 500 falls 20% in a bear market. This is the primary risks investors take in pursuit of long-term growth, because without market risk, there is usually no meaningful return. If an investment has no chance of loss, everyone would want it. As demand increases, returns would be driven lower and lower. See, investors are compensated for enduring uncertainty. Companies can miss earnings, recessions happen, markets panic. Historically, over longer time frames, stocks have delivered higher returns than cash because investors were willing to tolerate those ups and downs. Many investors see volatility as a flaw. In reality, volatility is often the admission price for growth. Number 2, inflation risks. This is a risk that your purchasing power will decline over time. For example, a gallon of milk, a car, or a vacation will cost substantially more 20 years from now than it does today. It's one of the greatest long-term threats to retirees and conservative investors. A portfolio that never loses money but earns less than inflation is slowly losing wealth. Imagine earning 2% annually while inflation averages 3%. You see, your account balance is going to rise every year, but your purchasing power is going to fall every year. It's like running on a treadmill moving backwards. Many investors become so focused on avoiding market declines that they overlook the silent erosion caused by inflation. The greatest danger isn't always seeing your balance fall. Sometimes it's watching it grow too slowly. Number 3, interest rate risk. This is a risk that rising interest rates will reduce the value of existing bonds. Many bond funds experienced significant losses in 2022 as interest rates rose rapidly. This is a major consideration for retirees and income-focused investors. Bonds are not risk-free. For years, investors viewed bonds as the safe side of the portfolio. Then 2022 reminded everyone that bonds can lose value and sometimes significantly. You see, what happens is when interest rates rise, older bonds paying lower interest rates become less attractive, causing their prices to fall. Investors often confuse safe from default with safe from price fluctuations, and these are not the same thing. Bonds can help reduce overall volatility, but they still carry risks that must be understood. Number 4, longevity risk. This is the risk of outliving your money. Simple enough. Retire at age 62 and live to age 95, 33 years in retirement. This is perhaps one of the biggest challenges that retirees face today. A longer life is a blessing, but it requires a longer financial plan. A healthy 65-year-old couple has a very realistic chance that one of the spouses will live well into their 90s. This means retirement could last 30 years or longer. Ironically, many people spend more time worrying about market crashes than longevity risk, even though running out of money because you live too long can be far more damaging. Retirement planning isn't just about wealth building. It's about making sure that that wealth lasts. Number 5, sequence of returns risk. The risk that poor investment returns occur early in retirement. For example, retiring in 2000, 2008, or any other period immediately followed by a major market decline. This is particularly scary in the first 10 years of retirement. The order of returns matters more than the average return. 2 retirees can earn the exact same average return over retirement and end up with dramatically different outcomes because withdrawals made during a market downturn permanently reduce the amount of money available to participate in the eventual recovery. A bad sequence of returns early in retirement can cause lasting damage even if markets recover later. That is why retirement planning isn't just an investment challenge, it's also a cash flow challenge. Number 6, Concentration risk. This is having too much money invested in any single company, sector, or asset. Example, holding half of your net worth in your company's stock. Sure, this can create substantial wealth, but it can also destroy it. Many fortunes are made through concentration. Most are preserved through diversification. Many entrepreneurs, founders, executives, and investors built their wealth through concentrated positions. The problem is that what creates wealth is often different from what protects it. History is filled with stories of people who became wealthy through concentration and lost much of it because they never diversified. See Enron and WorldCom, to name a few. Concentration creates possibility, but diversification creates durability. Number 7, liquidity risk. This is the risk that you cannot access your money when needed. For example, private equity, private credit, real estate investments, and hedge funds that may lock up your capital for years. These can potentially enhance your returns. Investors are often paid extra for giving up liquidity, but you see public stocks can be sold in seconds, while private investments often require investors to commit capital for years, because markets frequently reward investors for accepting less liquidity. This additional expected return is also called the illiquidity premium. The challenge is balancing opportunity with flexibility. A great investment can become a problem if you need cash and you cannot access it. Number 8, behavioral risk. This is the risk that emotions lead to poor investment decisions. For example, selling during a market crash or chasing performance after markets have already surged. This is the only risk completely under an investor's control. The greatest threat to a portfolio often isn't the market. It's you, it's the investor. Investors tend to buy when they feel confident and sell when they feel fearful. Unfortunately, confidence is often near market peaks and fear is usually near market bottoms. Opportunity cost risk. This is the risk of being too conservative and missing long-term growth opportunities. Keeping a large portion of your wealth in cash for years, while stocks, businesses, and other productive assets appreciate significantly. Often overlooked, but one of the most common risks faced by retirees and high net worth investors. Playing it safe can be risky. Many investors focus on what they might lose and spend very little time thinking about what they might miss. After a market decline, it's very common to hear investors say they're moving to cash until things feel safer. The problem is they don't ring a bell at the bottom. The markets often recover before investors are comfortable getting back in. Opportunity cost is invisible. You never receive a statement showing the wealth you could have had you remain invested. A portfolio that is too conservative may protect against short-term volatility while creating a greater risk of failing to meet long-term goals. Sometimes the greatest risk isn't losing money, it's failing to grow it. The market has recovered from recessions, bear markets, wars, political crises, and countless other challenges. The biggest question is whether investors stay invested long enough to benefit through the recoveries. Behavioral mistakes can undo decades of good planning. In closing, every investment return is tied to a risk. The question isn't whether you can eliminate risk, because you can't. It's which risks are you willing to take and are you being compensated for them? The best investors aren't the ones who avoid the risk. They're the ones who understand it, manage it, and use it to their advantage. Not all risk is bad. Some risks are exactly what create the opportunity. Thank you so much for listening in. I hope you've learned something. Please give us a like for the algorithm and share with someone who could use it. Thank you for your time today.